Moving averages are like smoothing filters for stock prices. Imagine a bumpy road. Moving averages are like shock absorbers, making the ride smoother. They help traders see the main trend without getting distracted by daily price jumps. Instead of looking at just one day's price, a moving average tells you the average price over a set period. This could be 10 days, 50 days, or any time frame you choose. By averaging past prices, we get a clearer picture of where the stock has been and where it might be heading. In the image above, the jagged line represents the daily price fluctuations of a stock. The smoother line is the 20-day moving average. Notice how the moving average helps to visualize the overall trend, even when prices jump up and down. The simplest type of moving average is aptly called the simple moving average, or SMA. To calculate it, you add up the closing prices of a stock over a certain number of periods and then divide by the number of periods. For example, a 10-day SMA is the average closing price over the last 10 trading days. Each day the oldest price is dropped and the newest price is added, creating a rolling average. SMAs are like the foundation of moving averages. They give equal weight to all prices in the calculation. This makes them easy to understand and apply to charts. While simple moving averages are great, they have one drawback. They give equal importance to all data points. But in the stock market, recent prices often matter more. This is where exponential moving averages, or EMAs, come in. EMAs give more weight to recent prices, making them more responsive to new information. This makes them particularly useful for short-term trading, where quick reactions to price changes are crucial. As you can see in the image, the EMA, represented by the blue line, reacts more quickly to the changing prices compared to the SMA, shown by the red line. This sensitivity to recent data makes EMAs a favorite among traders who need to stay ahead of the curve. Weighted moving averages, or WMAs, take the concept of emphasizing recent data even further. They assign a specific weight to each price in the calculation period, with the most recent price receiving the highest weight. This weighting system makes WMAs highly sensitive to current market sentiment and price fluctuations. Traders often use WMAs when they need a moving average that reacts swiftly to the latest market moves. In this example, the most recent price has the highest weight, and the weights decrease as we move back in time. This ensures that the WMA is heavily influenced by the most recent price action. Section 5. Identifying trends with moving averages. Moving averages are powerful tools for identifying trends in the market. When the price of a stock is consistently above its moving average, it suggests an uptrend. Conversely, when the price is consistently below its moving average, it signals a downtrend. Traders often use multiple moving averages with different time frames to confirm trends. For example, they might use a 50-day moving average to identify the long-term trend and a 20-day moving average to spot shorter-term fluctuations within that trend. In this chart, the crossover of the 20-day moving average above the 50-day moving average generates a buy signal, indicating a potential uptrend. Conversely, a crossover below would suggest a bearish trend. Section 6. Practical tips for setting up moving averages. Setting up moving averages on your trading charts is simple. Most charting software allows you to add them with just a few clicks. Experiment with different time frames to find what works best for your trading style and the specific market you are analyzing. For long-term investments, you might use longer moving averages such as 100-day or 200-day MAs. For short-term trading, shorter periods like 10-day or 20-day MAs might be more suitable. Remember, there's no one-size-fits-all approach. The key is to experiment and find the settings that align with your trading goals and risk tolerance. Section 7. Crossover strategies. Capitalizing on price momentum. One of the most popular ways to use moving averages is in crossover strategies. This involves using two or more moving averages with different time frames. When the faster moving average crosses above the slower one, it generates a buy signal suggesting that momentum is shifting upwards. Conversely, when the faster MA crosses below the slower MA, it generates a sell signal, indicating a potential downward shift in momentum. Crossover strategies can be particularly effective in trending markets. However, it's essential to remember that no trading strategy is foolproof, and it's crucial to manage risk and protect your capital. Section 8. moving averages as support and resistance levels. Another valuable application of moving averages is using them to identify potential support and resistance levels. In an uptrend, a moving average can act as a support level, preventing the price from falling further. Conversely, in a downtrend, a moving average can act as resistance, preventing the price from rising higher. As you can see in this example, the price bounces off the 50-day MA multiple times, indicating its role as a support level. Traders often use these levels to place buy orders near support and sell orders near resistance. Section 9. Conclusion: the enduring relevance of moving averages. Moving averages are like seasoned veterans in the world of technical analysis. They've been around for decades, and their popularity endures for a reason: they work. By smoothing out price data, they help traders cut through the noise and focus on the underlying trend. Whether you're a seasoned trader or just starting your journey, understanding and utilizing moving averages can be a valuable addition to your trading toolkit. Remember to experiment with different types, time frames, and strategies to find what works best for you.